So when you say capitalism is broken, it's a complete fraud.
People say, well, why is that?
The system unto itself is not working perfectly.
Inclusive and fair economies.
A fundamental reshaping of finance.
Over the last decade, there's been a profound change in the way corporations interact with society. Gone are the days when large multinational corporations were just soulless profit-making machines. Instead, these days, businesses are trying to give back to society, donating millions of dollars to charities and actively engaging in widespread social movements. At first glance, it's undoubtedly a noble pursuit, but dig a little deeper and you'll find a much darker side to this story. Because behind the scenes, an entire industry on Wall Street has been propped up to inexplicably sabotage this growing movement, turning it into a profit-printing machine designed to line the pockets of select financiers and corporate executives. It's a story of unparalleled greed and perverse incentives, one that's easily overlooked and often underreported despite its far-reaching consequences for our society. Over the last few decades, our economic system has come under ever-increasing scrutiny, catalyzed by major societal issues like climate change, income inequality, and institutional corruption. For many, these issues are seen as a byproduct of a much broader issue: corporations and their relentless pursuit for profit. A relentless pursuit that often leads these companies to engage in some pretty questionable behavior. I mean, there's a reason why fossil fuel companies like ExxonMobil and Shell pollute the environment, and tech companies like Facebook and TikTok make addicting products. It makes money. But for many, this relentless pursuit for profits has gone way too far, with many calling upon companies to disclose the impact their businesses have on societal well-being, and demonstrate a transition away from business practices that are harmful to society. It's a trend that's given rise to the concept of ESG, an acronym that stands for environmental, social, and governance. Essentially a set of standards many have started using to evaluate the impact that businesses have on society. And this brings us to where we are today. Today, companies are constantly scrutinized on their ESG performance, with many companies plowing millions of dollars into business plans that promote these environmental and social ideals. On the flip side, companies that fail to demonstrate a commitment to ESG are often lambasted by the media and boycotted by consumers who don't want to support corporations that have a negative impact on society. But some of the strongest supporters for the ESG movement come from an unlikely group of proponents: Wall Street bankers. A corner of our economy not typically known for their interest in societal well-being, but certainly known for, making money. Despite this, many bankers have uncharacteristically called upon companies to do more than just generate profits, and instead contribute to society at large. It's a trend that's led to the rise of ESG investing on Wall Street, a practice of investing in companies based on their commitment to business practices that reflect strong environmental and social values. Doing so is intended to help companies that do good for society grow faster than those that don't, creating an incentive for all companies to become more socially and environmentally conscious. It's a new perspective that's become incredibly popular, not only for millennials as they enter their prime wage-earning years and begin investing for retirement, but also for institutional investors like pension funds and college endowments, who have long been criticized for investments in fossil fuels and other industries that are harmful to society. In fact, ESG investing has grown to become so popular among socially conscious investors that more than $16 trillion are now being invested based on companies' adherence to ESG values. To put that into perspective, that means that nearly 1 out of every $3 being invested today into financial markets is being done through ESG investing. And this all sounds good, right? I mean, why shouldn't we reward good corporate behavior? But is that really what's going on here? Why is Wall Street suddenly calling upon companies to prioritize societal well-being over profits? After all, these are the very same bankers who for years facilitated the very same behavior that they're now trying to condemn. So in this episode, we're going to take a look at what's really behind Wall Street's sudden interest in the ESG movement, who ultimately stands to benefit from the surge in demand for ESG investing, and why the very idea of a company's commitment to ESG might not actually be everything it claims to be. One of the loudest voices behind Wall Street's embrace of the ESG movement is a company called BlackRock. Led by its CEO, Larry Fink, BlackRock has become the poster child for the ESG movement ever since Fink published a now famous letter called A Sense of Purpose in 2018. In it, he introduced the idea that companies have an obligation to serve a social purpose and make a positive contribution to society at large, instead of just simply generating profits for shareholders. But it was hardly the first time a CEO had ever preached about the virtues of the ESG movement, since it had long been in vogue for many business leaders to position themselves as emissaries of societal well-being as a way to promote their brand and attract more customers. But this time was different. Because this time it was the first time that anyone as powerful and instrumental to the very well-being of the global economy had ever inserted themselves into the conversation surrounding ESG. See, BlackRock is a very specific type of financial institution called an investment manager, which does pretty much what it sounds like. It manages investments for its clients. They operate what are known as investment funds that collect money from institutions like pension funds and college endowments and invest it into the stock market on their behalf. It's the type of business that's easy to overlook, but in reality can have incredibly profound impacts on the economy and society at large because of the sheer size that some of these investment managers have grown to become. And BlackRock has undeniably become the biggest of them all, with the company growing to manage nearly $10 trillion of client assets across the various pension funds, endowments, and other institutions it serves. But what's more important than the amount of money BlackRock manages is the power and influence that money gives them. Because of the sheer magnitude of capital that BlackRock manages on behalf of its clients, BlackRock has come to amass sizable stakes in nearly every company that trades on the stock market. Companies like Apple, Microsoft, Facebook, and ExxonMobil. In fact, BlackRock controls at least a 5% stake in every single one of the 500 biggest companies in the US. Now, of course, that doesn't mean that Larry Fink and BlackRock have direct ownership over these stakes, because at the end of the day, it's still the client's money being invested. But what it does mean is that while those clients let BlackRock manage their investments, BlackRock is able to act indirectly as the owner of these stakes, allowing them to vote on behalf of their clients when it comes to critical corporate decisions, like which executives should be elected to lead the company, how much to pay them, and the overall direction of the company and the business it runs. And with BlackRock controlling such a massive number of votes, the company has a huge say in what does and doesn't go on at many of these companies. That's why when BlackRock's CEO began talking about how companies needed to prioritize not only profits, but also the well-being of society, corporate executives around the world had no choice but to pay attention and get on board. And Fink quickly showed corporations that he wasn't just all talk, and that he would be backing his words up with real actions to promote the idea of ESG across corporate America. Because over the next few years, BlackRock began actively pushing corporations to adopt ESG-friendly policies, like increasing the diversity of their corporate executives and mandating that companies take on greater corporate social responsibility. Corporate executives who didn't get in line were punished, with BlackRock often blocking the appointment of CEOs and other key executives who didn't follow the company's ESG agenda. So it seemed like BlackRock really was serious about the ESG movement after all. It was a realization that shocked many on Wall Street. After all, it was pretty common knowledge that ESG initiatives aren't exactly the most profitable. I mean, going through the effort of making sure your supply chain is free of any ethical concerns, like environmental pollution or even child labor, is costly to a business. Instead, it can make a lot more financial sense to just turn a blind eye to any negative effects that your business might have on society. But that begs the question, how is BlackRock's sudden interest in ESG initiatives aligned with their own business interests? Well, to truly understand where BlackRock's interests lie and see what brought them to this point, we need to take a look at the business mechanics behind BlackRock to understand what their underlying incentives might be. Over the last 40 years, the investment management industry has gone through some pretty significant changes. Back in the 1980s, the investment management industry was in its heyday. The stock market was on a tear, and star investment managers on Wall Street were constantly getting profiled in the newspaper for the eye-watering amounts of money they were generating for their clients through the investments they managed on their behalf. The industry could hardly keep count of all the money it was raking in through the high fees it was charging clients to get access to the industry's lucrative investment funds. But like most industries, the investment management business fell prey to the disruptive potential of technology, because over the next few decades, much of the investment management industry became automated by computers, which were much cheaper to operate than a trading floor full of Ivy League educated financiers. And like most industries that become commoditized, investment managers turned to the one thing they could use to distinguish themselves from the competition: their fees. It started a race to the bottom as competing investment managers went back and forth, seeing who could lower their fees the most as a way to attract more customers, a competition which saw average fees charged across the industry get cut by 50%. Now, for your typical mom and pop investor that was investing in hopes of an early retirement, things couldn't have been better, since they had to pay fewer and fewer fees. But on Wall Street, things couldn't have been worse, as the industry's primary source of revenue continued shrinking year after year, seemingly with no end in sight. It was a trend that BlackRock was all too aware of, as many rival firms were forced to close shop and exit the industry, unable to stay in business while the industry's primary source of revenue continued to shrink year after year. For CEO Larry Fink, it was clear he needed to find a way to rejuvenate his business and breathe new life into the fees BlackRock was charging its clients. The only question was how. How could BlackRock convince investors to pay above-average fees at a time when fees across the industry were plummeting? It was a question that demanded an answer if BlackRock were to survive, an answer that Larry Fink found with the rise of the ESG movement. See, by promoting the virtues of ESG and rewarding companies that were perceived as good corporate citizens, BlackRock began slowly moving the needle in terms of corporate decision-making and what caught investors' attention. ESG was no longer just a social movement. Instead, BlackRock framed the issue as a moral imperative, something that you could stand behind because you knew it was the ethical thing to do. And once BlackRock got society emotionally invested in the cause, they created a way to become financially invested as well. Because at the same time Larry Fink and BlackRock quickly rose to become Wall Street's biggest advocate of the ESG movement, receiving numerous accolades and media publicity for the company's tough stance on climate change and corporate social responsibility, the company began quietly launching hundreds of financial products that met the very demand they were creating. Just scrolling through BlackRock's website shows hundreds of different investment products that are targeted specifically at ESG-conscious investors. Anything from investment funds that promote social values like diversity, equity, and inclusion, to investments in companies whose products address social and environmental issues globally. And so far, these funds have turned out to be a huge hit among ESG-minded investors, with clients plowing over $500 billion into BlackRock's ESG-themed investment products. But of course, once you get past all the buzzwords and claims of investing in progress, you see a completely different side of BlackRock's love affair with the ESG movement. Because only after reading through the small print on many of these investment products can we see that the fees charged to investors on many of these ESG products are unbelievably high, significantly more than any of the fees charged by the company for its non-ESG funds. For example, if we compare the fees charged by one of BlackRock's most popular non-ESG funds and compare it to the company's ESG version of that same fund, we can see that the fees charged by the ESG version are nearly 5 times higher than those charged for the non-ESG version. And this is hardly an exception. On average, ESG funds typically have 3 times higher fees than non-ESG funds. It's a pattern that seems to contradict BlackRock's public statements that they want to encourage more investment according to ESG principles. After all, if they thought this was such an important cause, why would they make it more expensive to do so? Instead, it seems like BlackRock has come to the realization that the willingness of some investors to invest in a more ethical manner provides BlackRock with an opportunity to extract higher fees from those clients. Fees that translate into real revenue for BlackRock, with the company pulling in an estimated $750 million in management fees each year across all of its ESG funds. But if we look beyond the revenue that BlackRock is pulling in and actually take a second look at the company's ESG investment products, a much more nefarious exploitation of these ESG-minded investors comes to life, something far more sinister than simply overcharging them on fees. Because if we take a look at some of the companies held within BlackRock's ESG funds, it's not exactly what you might think. Take BlackRock's Carbon Transition Readiness Fund. BlackRock markets the fund as ESG according to its prospectus. But looking through the list of companies included in the fund's investments, you might be pretty surprised to see a bunch of companies from the oil and gas industry. Companies including the likes of ExxonMobil, Chevron, and Occidental Petroleum, some of the largest multinational fossil fuel companies. Likewise, you'd also be pretty surprised to see a whole group of financial institutions that have historically bankrolled the business activities of the oil and gas industry. Companies like JP Morgan, which has long been the biggest financier of fossil fuel projects, financing over $300 billion of fossil fuel projects between 2015 and 2020 alone. I mean, it's surprising that any of these companies would be anywhere near an investment product that's advertised to be all about climate change. But this example is hardly an anomaly. In fact, it's a common theme across pretty much all of BlackRock's investment products that are advertised as promoting ESG values. Looking through BlackRock's products, we can see ones that are advertised as ESG that contain weapons manufacturers, tobacco companies, and operators of private prisons. So what exactly is going on here? How can BlackRock sell investment products which are marketed as ESG while simultaneously stuffing those same investment products with companies that have a horrible impact on society? Is this just blatant greenwashing, or does it actually go far deeper than that? Well, to answer that question, we have to look at a company called MSCI. Led by CEO Henry Fernandez, who's run MSCI ever since its founding in 1998, the company has long been an integral part of the machine that runs Wall Street. Since its founding, MSCI has always been an analytics company. It was a pretty boring and mundane business by Wall Street standards, making money by selling various data and analytics products to many banks on Wall Street. It was a business that performed pretty well, delivering steady, consistent revenue year after year. But it was a far cry from the money-making machines that most other Wall Street institutions had become. Even in the run-up to the financial crisis in 2008, when most other institutions on Wall Street were posting record profits, MSCI lagged the rest of its industry, with revenue growing at a meager 3% growth rate. So coming out of the financial crisis, Fernandez knew something had to change if he wanted to break out of the shadows of Wall Street's major investment banks. Just like Larry Fink had done at BlackRock, Fernandez recognized the business opportunity that could be made out of the interest that was quickly growing around ESG investing, and began considering different ways of getting involved in the industry. He quickly realized that while there was a huge demand among investors to invest in companies with strong ESG track records, there was no standardized way to evaluate which companies fit that description and which didn't. In response, Fernandez created an entirely new subsector of the ESG industry, launching what he called an ESG rating agency. The idea was pretty simple. MSCI would act as an independent third party, evaluating different companies based on their social and environmental impact. Their findings would then be reflected in one of 7 ESG ratings, ranging from CCC to AAA. Companies that had the worst ESG track record were given a CCC or single B rating, and were categorized as ESG laggers. Companies that had a more neutral stance on ESG were given BB, BBB, or single A ratings, and were considered average. And finally, companies that demonstrated the very best ESG standards were given AA or AAA ratings, and were considered ESG leaders. For the ESG industry, it was a system that was a total game changer. It was the first time that anyone could quickly get a sense of a company's ESG performance without spending hours of time reading up and researching the company's track record. On top of that, the analysis and evaluation that formed these ESG ratings were being conducted by MSCI, a company that was totally independent of the ESG industry and frankly was the farthest thing from the typical money-hungry business that people had come to expect from Wall Street. And at the same time, Fernandez began preaching about the need for companies to be environmentally and socially aware, urging more companies to make real commitments to their ESG efforts. During one 2019 presentation, he even went so far as to say that the mission of MSCI was to help global investors build better portfolios for a better world. It was the type of thing that only added to the credibility that the company's ESG ratings were quickly gathering in the industry. But as it turns out, if we actually take a hard look at how MSCI designs its ESG rating system, that allure of credibility would disappear pretty quickly. Because in reality, there's virtually no connection between the way MSCI forms its ESG ratings and the company's claim that its goal is to create a better world. That's because their ESG ratings don't actually measure a company's impact on society. Instead, they measure the exact opposite, the potential impact that climate change and governmental regulation around ESG might hurt the company's ability to generate profits. That's right, MSCI's ESG ratings aren't measuring how well a company is upholding ESG values. They're measuring how damaging the growing adoption of ESG will be to a company's bottom line. Take McDonald's, for instance, the world's largest producer of fast food. To fuel its menus of Big Macs and hamburgers, the company has become the world's largest purchaser of beef, building a business empire that generates 54 million tons of greenhouse gas emissions, greater than the total emissions from entire countries like Portugal and Hungary. But in April of 2021, MSCI upgraded the ESG rating it gave McDonald's from a BB to a BBB rating, citing of all things the company's strong environmental practices. How? Well, it turns out that MSCI determined that climate change didn't pose a risk to the company's ability to generate profits, because as long as new laws and regulations weren't enacted to limit McDonald's environmental pollution, the company's emissions are viewed as irrelevant to McDonald's ability to generate revenue, which MSCI used as a way to rationalize dropping carbon emissions as a factor it considered when calculating McDonald's ESG rating. But McDonald's ESG rating is hardly unique. In fact, if you take a look at pretty much any other company that has a horrible ESG track record, you'll see an ESG rating that reflects the exact opposite. Take Philip Morris, the tobacco conglomerate behind Marlboro and dozens of other tobacco companies that on average kill half of its users. When it came time to evaluate Philip Morris, MSCI gave the company an ESG rating of BBB, qualifying the company as an average ESG performer. Likewise, Coca-Cola, the company that probably made the biggest contribution to the childhood obesity crisis that currently impacts 15 million children in the US alone, and has a long history of funding research that downplays the negative health impact of soda, is considered an ESG leader by MSCI. Even Lockheed Martin, the weapons manufacturer whose weapon systems have been used to kill women and children across many war zones around the world, was given an ESG rating of AAA, also making it an ESG leader in the eyes of MSCI. But one particularly mind-boggling component of MSCI's ESG rating system is its use of industry relative scores. In other words, when MSCI rates a company's ESG performance, it makes its rating assessment based partly on how that company performs in comparison to the performance of its competitors. That's how you end up with the truly absurd ESG ratings that are seen in the fossil fuel industry. Shell, which is one of the largest oil producers in America, has an ESG rating of AA according to MSCI. How? Well, it turns out that when MSCI was creating the ESG ratings for companies in the oil and gas industry, Shell performed ever so slightly better than its two primary competitors, Chevron and ExxonMobil, who were both deemed average, receiving single A and triple B ratings respectively. Put aside the fact that all three of these companies are the complete antithesis of what ESG is supposed to be, only because Shell does a marginally better job than Chevron and Exxon, it was given a favorable ESG rating, allowing it to secure the classification of an ESG leader. And it's obfuscation like this that has turned MSCI into the most integral part of the money printing machine that the ESG industry has become on Wall Street. Because investment managers like BlackRock will pay MSCI millions of dollars to license the company's ESG ratings, and then turn around and use these supposedly favorable ESG ratings as justification to include them in investment products marketed to socially conscious investors. They don't care that the companies they list in their ESG investment products have horrible ESG track records. After all, BlackRock's incentive is to sell as many ESG investment products as they can, because they're far more profitable than the company's non-ESG products. So BlackRock is more than happy to rely on MSCI's rating system, despite its obvious deficiencies, since it suggests that far more companies are ESG friendly, allowing BlackRock to consider more companies and therefore create more investment products that they can deceptively market and sell to ESG conscious investors. After all, if MSCI's ESG ratings were actually aligned to real ESG considerations, far fewer companies would be deemed ESG, leaving BlackRock with far fewer companies to make investment products out of. And we shouldn't expect this dynamic to end anytime soon, because BlackRock's ESG business has become increasingly dependent on the ratings that MSCI sells, with BlackRock quickly becoming MSCI's biggest customer. It's a business relation that has led MSCI's profits to explode in recent years, growing from $150 million in 2009 to well over $1 billion in 2022. The unfortunate irony behind all this is that this success has also turned MSCI's CEO Henry Fernandez into the first billionaire created by the ESG movement, a telling sign for a man who claimed that his company's goal was to create a better world. But while BlackRock and MSCI stack profits, investors are undoubtedly left holding the bag. Ordinary mom-and-pop investors who are looking to invest for their retirement and want to make sure that their investments are aligned with their personal values are none the wiser when they see an investment product labeled as ESG. Even more sophisticated investors couldn't be blamed for not knowing what's going on inside the ratings that are used to construct these ESG products. That's because MSCI's detailed reports for each company's ESG ratings are only sold to financial institutions. So even investors that are pretty financially literate are unlikely to grasp the full extent to which these ESG ratings have little to do with real ESG values. And BlackRock hardly provides any clarity. Instead, they keep the description of their investment products on their website incredibly vague. For example, if you take a look at the perspective of one ESG product based on MSCI's ESG rating, BlackRock simply says that the product includes companies that have favorable environmental, social, and governance ratings, without actually explaining what favorable actually means and how those ratings were actually made. Only if you were to look at the very last page and read through the fine print would you see that BlackRock acknowledges that companies selected by MSCI may not exhibit positive or favorable ESG characteristics. And after all, who really reads through the fine print? And as more and more companies look to the ESG industry, tempted by the prospect of taking advantage of socially and environmentally conscious investors, companies have begun piling into the ESG industry, leading to a string of unscrupulous activity that's unethical at best and at worst, outright fraudulent. Recognizing the value that can be unlocked by marketing investment products as ESG, some financial institutions have gone so far as to simply slap ESG-related buzzwords onto many of their existing investment products, while making little to no actual changes to the investments contained in the products sold to investors. In one instance back in 2020, Goldman Sachs took an investment product it called its Blue Chip Fund and rebranded it as the U.S. Equity ESG Fund, claiming that the holdings of the fund would be subject to an ESG analysis. However, when reading through the small text of the fund's prospectus, Goldman mentions that the investment bank reserves the right to invest in some companies without such screening. And conveniently enough, the holdings of the fund have remained largely unchanged since undergoing its ESG rebranding. In a similar case at Bank of New York Mellon, the bank was operating an investment fund that was marketed as being ESG themed, despite the fact that its investments never actually underwent any type of ESG screening, a fact that was pretty obvious after looking at the fund's contents, in which 67 of the fund's 185 investments didn't even have an ESG rating at the time the product was launched. It's a worrying trend that's caught the eye of regulators, with both Goldman Sachs and Bank of New York Mellon being charged for their fraudulent claims to investors. However, both investment banks ultimately settled with regulators, allowing them to escape without admitting or denying the charges. Instead, both companies agreed to pay million-dollar fines that hardly put a dent in the growing profit financial institutions on Wall Street have pulled in over the last decade while falsely touting the ESG movement. But how can financial institutions get away with this type of stuff? How are these investment banks getting away with nothing more than a slap on their wrist? Well, as it turns out, regulating the ESG industry and its supposed desire to do good for society isn't as easy as it sounds, because nearly everyone has a different perspective on what's considered good for society. Because nowadays, MSCI isn't the only ESG rating agency on Wall Street anymore. Seeing the incredible profits that MSCI was raking in through its relationship with BlackRock, more than 160 different companies have jumped into the industry to form their own rating agency, including the three biggest corporate credit rating agencies, S&P, Moody's, and Fitch. The same three credit rating agencies whose lax rating standards contributed to the collapse of the housing market and brought about the global financial crisis of 2008. But unfortunately, the parallels to the 2008 financial crisis don't stop there. Because if you take a hard look at the different rating agencies out there, you'll notice something incredibly bizarre. It turns out that each rating agency has its own unique spin on how to evaluate a company's ESG performance, which means ESG ratings for any one company can vary wildly across different agencies. Take Amazon, for example. According to MSCI, Amazon has a solid ESG track record, with the company giving it an A rating. But depending on which rating agency you check, you could get a completely different impression, with some agencies rating Amazon much higher when it comes to their ESG efforts, while other agencies have opted to issue ratings that are much lower. The end result is pure confusion, since no one can really tell whether Amazon, or any other company for that matter, really is a strong contributor to the ESG movement or not. But of course, this only works to the advantage of Wall Street, which can pretty much find a way to justify literally any investment product they can come up with as ESG. Because if one rating agency doesn't provide a favorable enough ESG rating, they can just walk down the street and find another one that will. And despite regulators' attempts to regulate the industry and enforce more clarity around what should or shouldn't be considered ESG, Wall Street has continuously managed to stonewall any attempts to threaten the industry's latest profit-printing machine. Because pretty much any attempt to enact legislation that forces BlackRock or any other Wall Street giant to give investors more information about how they're creating their ESG investment products have been blocked by extensive lobbying by BlackRock, claiming that the proposed ideas could lead to the disclosure of proprietary information. In other words, it would unveil the mirage that Wall Street has been playing. So as a result, Wall Street has been left to play in an entirely unregulated market, where investment products falsely touting ESG principles are only set to continue growing. And the unfortunate irony behind all this is that as the industry continues to grow, it unwittingly exacerbates the very problem it's claiming to solve. Because at the end of the day, all the ESG industry is selling to society is a giant placebo, a product that's been expertly marketed as a quick and easy fix to a set of incredibly complex problems. It's a placebo that's really just a Trojan horse that tricks investors into giving greedy salesmen more money and lets companies greenwash themselves. Because while the ESG movement has presented itself as this radical new form of business thinking, it's really just regular old capitalism at its slickest and slimiest. Ingenious marketing in the service of profits above all else.